Welcome back. You are watching the Oasis Focus and Finance show, and we are having a look at global funds and more specifically the 15th anniversary of the Oasis Crescent Global Equity Fund. Our special guest in studio is Ebrahim, CEO of the Oasis Group. Adam, let's go to the next question at hand. We are living in very interesting economic times. How are your global funds competing? How are they doing in this rather interesting, if not challenging, environment?
Isn't that the old Chinese saying that we're living in interesting times?
Absolutely.
And so a big part of the issues today is coming out of China and emerging markets. There are two issues: China, emerging markets, as the economies change, and debt. And China and most emerging markets are moving from a point where they're investing, or they have been for 20, 30 years, have been investing in bridges and buildings and dams and everything infrastructure-wise, and they've been spending very little on consumer goods. And the net result is, over that period, they were buying the coal and the iron ore that we were producing, and now, over the last 2 to 3 years, there's been a transition. They've got enough bridges. They don't need more bridges. They need more food, more cars, more household products. You know, the Chinese need to start looking a bit pretty. They need to spend money on health. And all of those things, that transition isn't a smooth transition, because your whole mindset in one instance was to build the bridges. Now you've got to take Jane, who was a construction foreman, and now convince her that she's got to buy cosmetics and a handbag and do her hair. And that process is a change, and it's a long-term process. And so we're going through that transition where the countries that export to China iron ore and copper and those really struggle, and we're in that category. And the countries that are exporting the Nike shoes and Adidas shoes and shirts and cosmetics and all sorts of things are starting to do really well, but it's not an even curve in both ways. And a lot of the kind of infrastructure for a more from a mindset point of view, and infrastructure from converting from an industrial-based economy to more of a consumption-based economy, that's what we're going through at the moment. That reinforced by our very, very, very high level of debt in emerging markets. These are the countries like China, like South Africa, like Brazil, that since 2008, you know, the financial crisis was as a result of debt in the Western world. And the fact that the Western world was uncompetitive, we've almost moved full cycle, 360 degrees, and it's now the emerging markets that have got the debt, and the emerging markets that actually have got high costs. So we actually going to go through 2-3 year period of very, very volatile and difficult times, and we can see it in South Africa. And you know, before we normalize, we don't think it's a repeat of 1998 when it just boom was quite dramatic. It will be a slow decline before it normalizes. But what emerging markets have to do is reform, get our labor costs down. You know, we've got to get back to university, back to school. We're not going to compete by burning down our universities. And that environment means that the former economies that were doing poorly, the US, the UK, are actually doing very well. Even Europe is now starting to pick itself up. And so most of our money is in the US, UK, Europe, and we have very little money exposed to emerging markets. On the global side, we have very little money exposed to things like you know, commodities, and we you know, we own the companies like Henkel, who produce the hair products. You know, Adidas amongst others, because the Chinese are going to start running, and the Indians may start running, the Indonesians, and there's a lot of them. So if they get that going, you know, those countries, and suddenly those companies are doing really well. So if you look at it, our companies are 2.5 times more profitable, have got 1/3 the level of debt. So if interest rates go up, they're better protected. has 50% more cash flow, and you're buying them between 25 and 40% cheaper. So you're buying a fantastic company like a Rolls-Royce, and you're paying the price of a Fiat. And I know over the long run, the Rolls-Royce is going to be a much better quality, get me further, in more comfort and have more safety than the Fiat. I don't know what they call these days. I remember the box Fiats. I'm talking about the box Fiats. That's what you're paying for. And you're getting this Rolls-Royce. I know what I'd want. I want the Rolls-Royce and pay the price of a Fiat. What you don't want is the Fiat and pay the price of the Rolls-Royce. And we think that we have the right mix. And so what creates the opportunities? If the markets come down, then we find many companies, and that creates an opportunity. The second time there's an opportunity, if there's a sector that's having a tough time. Not that long ago, the introduction of Obamacare in America produced a lot of anxiety in the healthcare. We bought some of the best healthcare companies in the world through that, and that was fantastic. And then thirdly, if there's a stock-specific, a company-specific issue. Now we have two companies, the world's largest pharmacy, Walgreens. They also own Boots. They had a fight with one of their suppliers, so the share price came down. But they were one of the best companies in the world. When the share price came down, we did a lot of work. We bought Walgreens. And then WH Smith, they're the kind of bookstore on the high street, but importantly, in every airport, in most hospitals, in most train stations, you have WH Smith, and it's become global. And that created an opportunity when tourism was down in the UK and the stock was under pressure. We bought in, tourism's picked up globally, and so we're quite nimble. We focus on identifying companies. So the funds have done pretty well, and will continue to do well. And remember, when the markets are down, that is like the supply of oxygen that we need to buy these great companies. And then when the markets are up, we sell those and we take profits. And that's how we add value for our clients.
Now, Adam, obviously, when one is thinking of investing, and maybe people watching us right now are thinking, okay, they're getting excited now. Within the Oasis range of products, obviously, you always say one has to have a basket of products. I'm sure the same applies in the global fund arena. So how would you approach this particular matter? If somebody says, okay, Adam, I want to invest, but obviously I want to make sure I don't lose my money. So how do you do it?
In South Africa and globally, we have the building blocks, which is our equity fund, the Crescent equity fund, the property and the income, so short-term and long-term. And then we have balanced funds, high, medium and low. And the balanced funds take a combination of the building blocks, so you get the diversification. But within all of that, so you get geographic, so across countries, across continents, currency. So we've got a high exposure to dollar and a low exposure to some of the weaker currencies. Across sector, so we have a very high exposure to the global telecommunications sector, amongst others, and the global IT sector, and a low exposure to other sectors that are doing poorly. So you get a sectoral diversification, and then you get a company diversification. And so your portfolio in the Oasis Crescent balance high, balance medium, and balance low in South Africa, and globally balance medium and balance low, and we have a balance variable, gives you that attributes of significant diversification. But for each one of us, our risk profiles and our needs are slightly different, and we define those risk profiles and needs, different needs, by age or by time horizon till you need the money. So if you've got a very long-term horizon and you're young, then you'll go into the high equity balance fund. If you kind of have a medium-term time horizon, and also you're kind of getting to your 50s, and so you've got a medium-term time horizon, so the medium. So we've actually made it quite easy for the consumer to understand that. And then once you get to you've got a shorter time horizon, you're 65, you're now enjoying life, you stopped working, you're going on holiday, there's no money coming in, you're living off your investment pool, you have a shorter term time horizon, you have a lower risk, therefore we have the low equity balance fund. So to meet each one of those needs through your life cycle, those 3 products should be very good. And by the way, you know, from a South African investor who wants to invest globally, we just launching the low equity balance feeder fund shortly, which will give you that diversification for your global money. But you do have that in your current funds in South Africa, your 3 balance funds and your 3 underlying funds. So we think those funds actually adequately address all the needs. You also have tax incentivized general savings, the ISA, we have that. We have Hutch policies, we have general endowments. So we've got the full spectrum, both in South Africa and globally, where we can actually meet every need with, for every person who's actually saving for whatever need. And, you know, I think we're in a fantastic position. Now, importantly, it's been done by a private sector company with private family money, with entrepreneurship, with a team that's been internally, you know, built, with global systems, best practice. You know, our global funds on one of the largest wealth managers, they have more than 100 asset managers supplying them. We've been rated #1 most of the year in terms of service and administration, and that's what we need to keep doing. The more we keep excelling, the more we keep doing the very best we can do, and the more competitive we are, and the more we focus on our competitive viability and improve. You know, yesterday's competitiveness was fine. You've got to think about tomorrow and the day after's competitiveness. And that is my job as CEO of the organization. That's the job of my board, to have a forward-looking view for Oasis. We think 5-10 years ahead, and we plan 5-10 years ahead. And from our portfolios, we do the same. We're not positioning the portfolio for events today. We're actually positioning for, the portfolio for events over the next 5, 10, 15 years. So in theory, when an event happens, 99% of the time we've thought through the issues, and the portfolios are pretty well positioned. So we've got the product for everybody anywhere in the world. We've got the access through distribution, increasingly global, increasingly easy to get. And if you need to access us, we'll be in your hometown very quickly. We'll be in your homes very quickly with somebody from Oasis or from a partner coming to see you, or you going to see them. So in 18 years in South Africa and 15 years globally, I think, and without any acquisitions, can grow by acquisitions, it's quite easy, but just building block by block, grain by grain, and with solid foundations. Alhamdulillah, we've built an organization with the name Oasis, with the DNA of an Oasis, and everything that we kind of focus on is sustainability, growth, viability, and making sure we treat the environment and our society fairly and equally and ethically. And in all of this, we've paid our zakah, we've done our sadaqah. You know, what the untold story of Oasis is the broad smiles on tens of thousands of people everywhere in the world, from old age homes where the elderly are taken to the beach. Just a few weeks, you know, every week, a month they go out to the beach, they go to different, where the young kids are taken, and just the nur on their faces to be taken out and to be cared for. That is the nur of an Oasis.
Adam Ebrahim, CEO of Oasis, it's been a pleasure chatting, and of course congratulations, 15th anniversary of the Global Equity Fund, and of course IFN voting you the top Islamic asset management company in Africa. Everything of the best, inshallah.
Shafiq, to you and the viewers, thank you so much, and inshallah we have a great 2016 and a fantastic rest through the end of 2015.
I'm into that. You've been watching the Oasis Focus on Finance show. Join us next week when we talk about holiday spending and how to avoid the fiscal January hangover. Should you wish to contact Oasis, you can dial 0860 100 786 or info@oasiscrescent.com. Until next time, I'm your host, Shafiq Morton. Assalamu alaikum wa rahmatullah.